Today, we're exploring the admission of a new partner into an existing partnership by buying out a portion of the current partner's interest. When a new partner is admitted by purchasing an interest from the existing partners, the transaction is strictly between the individuals involved. It's not a transaction with the partnership entity itself. Let's consider a scenario to understand this better. On June 1st, Tom Andrews and Nathan Bell each sell 1/5 of their partnership equity in Bring It Consulting to Joe Cantor for $10,000 in cash. Before we delve into the numbers, remember that this is a private transaction between the individual partners. Here are the financials of the partnership on that day. Total assets stand at $120,000. Total liabilities are $20,000. This gives us net assets of $100,000. Both Andrews and Bell have capital balances of $50,000 each. Now, let's break down the transaction. Each partner, Andrews and Bell, sells a portion of their equity to Cantor. Specifically, 1/5 of their $50,000 capital balances amount to $10,000 each. Cantor pays this $10,000 in cash, effectively buying into the partnership. In accounting terms, this is how it works. Andrews and Bell's capital accounts decrease by $10,000 each. Cantor's new capital account is credited with $20,000, which is the total he paid to both Andrews and Bell. The only entry required by Bring It Consulting to record the transfer of capital from Andrews and Bell to Cantor is straightforward. Here's how it looks for a partnership. Debit: Tom Andrews, capital for $10,000. Debit: Nathan Bell, capital for $10,000. Credit: Joe Cantor, capital for $20,000. This accounting entry reflects the decrease in Andrews and Bell's capital accounts and the corresponding increase in Cantor's capital. But what if Bring It Consulting was structured as an LLC, a limited liability company, instead of a partnership? The process is similar, but the terminology differs. The entry to record the transfer of capital from Andrews and Bell to Cantor would be Debit: Tom Andrews, member equity for $10,000. Debit: Nathan Bell, member equity for $10,000. Credit: Joe Cantor, member equity for $20,000. Despite the different terminology, the essence of the transaction remains the same. Equity is transferred from the existing members to the new one. With the entries recorded, let's now visualize the effect of this transaction on the partnership accounts of Bring It Consulting. Here, we see the partnership's net assets remain at $100,000. This hasn't changed. What has changed is the distribution of capital among the partners. Tom Andrews' capital account now shows a balance of $40,000, reflecting a decrease of $10,000. Similarly, Nathan Bell's capital reflects the same decrease, now at $40,000. Joe Cantor's capital account is newly credited with $20,000, the sum paid to Andrews and Bell. After Joe Cantor's admission to Bring It Consulting, the total owner's equity remains unchanged at $100,000. This might seem counterintuitive, so let's unpack why that is. The amount Cantor pays for his share of the partnership does not affect the partnership's total equity. The total equity would remain the same whether Cantor paid the $20,000 we discussed or if he had paid $15,000 or even $25,000. Here's the reason. The transaction is between Andrews, Bell, and Cantor. It's not a transaction with the partnership itself. Any profit or loss from this sale belongs to Andrews and Bell personally. The partnership's books only reflect the change in capital accounts, not the gains or losses from the sale. This distinction is vital. It emphasizes the personal aspect of these transactions in a partnership. Each partner's financial decisions can affect their capital accounts but not the partnership's total equity. In conclusion, admitting a new partner into a partnership involves individual transactions that reallocate ownership but do not change the business's overall value.